Episode 3 of Benjamin's Boot Camp. Today we're going to be learning about fair value gaps. Now, again, if you're an intermediate or advanced trader, don't click off of this video because we are going to go in depth on fair value gaps as well later on in this video. So there's still things to learn if you already know what a fair value gap is. For my beginner traders, a fair value gap is a 3-candlestick pattern that creates a gap in between the first and the third pattern. I'm going to show you what it is. Don't worry. For example, you can see that we have a fair value gap here. Now, using hindsight, just guessing what it is, you can guess that drawing a box here, it's from this low to this high. And if it doesn't overlap, it leaves a gap here. Now, let's say we got rid of this candle and this candle wasn't here. You would see a gap here, right? There's no wick, there's no nothing, it would be nothing. That's a bullish fair value gap. Now, here's what price looks like when there isn't any fair value gap. As you can see, we draw out that box from there to there, and you can see that there is no gap there if this candle wasn't here because the wicks there are blocking it. So there's no fair value gap here. There's a fair value gap here, and there's also a fair value gap here. Now, same thing, vice versa for bearish fair value gaps, as you can see, and it doesn't need to be a correct candlestick pattern. It doesn't all need to be green candles or black candles. You can see down here we have a bearish fair value gap. It doesn't work, but it is a bearish fair value gap right here. Now, what is a fair value gap? Whoops. What is a fair value gap? A fair value gap is an inefficiency in price action. It lacks something. What does it lack? It lacks, how do I say this? A BISI and a SIBI. A bullish fair value gap is called a BISI. Buy side imbalance, sell side inefficiency. It's inefficient in bearish price action. So it needs to go back down to trade to it, kind of like getting a paint roller, right? This is your paint roller. And whenever you're brushing paint on a wall, you can't just go straight up and then you're done with one dip of paint because there's going to be spots. So when price moves up higher so much, there's spots here that price needs to roll back over. So whenever you're painting a wall, instead of just going up, right, you always go like this, up, down, up, down, up, down, because it's covering up the holes. Now, that's why we had this whole move here before moving up all the way back up here again, because price moved down to fill out those paint holes. A bullish and bearish fair value gaps is inefficiencies in price action. So a BISI and a SIBI, buy side imbalance, sell side inefficiency, and sell side imbalance, buy side inefficiency. These are called internal range liquidity zones. You can use zones. Price will draw to these internal range liquidity zones to then move up higher or lower again. So example, we were very bullish today, but price would draw back down into that BISI to then drive price up higher again because the markets move on accumulation, manipulation, distribution. Price needed to manipulate down lower so price can then drive up higher again. Because price can't just continue up higher, it has to go down and take some sort of sell-side liquidity. Now, sell-side liquidity isn't just lows, it's also internal range liquidity, like I explained in my video before this in episode 2 about liquidity, that price took a form of liquidity by trading into this fair value gap. Now, fair value gaps are one of the best PD arrays and the most important PD arrays to learn about in the concepts. So many models, including the one that I will be teaching you and the one that I use that made me profitable, it involves fair value gaps. So I recommend going in depth on fair value gaps and really learning what it is. So I'm going to jump into the notes that I've taken and I published in my private community, which is in the link in the description or the link in my bio, depending on where you're watching this. And you can see that I published a bunch of notes of a bunch of different type of PD arrays. This is just on fair value gaps. You can see that the gap occurs on the time frame you're looking at. You can break it down further on smaller time frames, but then it would probably be a liquidity void, not one gap. So what does that mean? When price moves down fast, when you drop time frames, it's probably a liquidity void. Now, what is a liquidity void compared to a fair value gap? Well, I'm going to tell you. I just need to find you an example. A liquidity void is when you see this right here where there's actually nothing. It's clear white price action. There's nothing here. This candle gap down to this candle. See, this is also a gap, inefficiency in bullish price action, but this is also a gap, inefficient in bullish price action. We draw to that already. Now we're drawing up to this gap here. That's what we're working our way to. So there's two types of, you can say fair value gaps. They're not fair value gaps. They're called volume imbalances or liquidity voids, but I like to just call them fair value gaps. So you can see there's an example there of a fair value gap. Price will likely fill that fair value gap. So that's why we use them as price targets, where we anticipate price is going to go fill that fair value gap. Why can we expect it to fill that gap? Because we already took sell side liquidity beneath that low with a turtle soup. What is a turtle soup? Brief example, there's a high, we go here, we take the high, we go back down lower. Now, I'll explain turtle soup in depth later on, way later on into this boot camp. But you can anticipate, right, a sweep of buy side liquidity. We trade down, fair value gap, move it down lower. Look at that, fair value gap there. That circle price range is already efficient price. Once we break the orange line to the downside, that's where the only sell side is delivered. Now, you can see that all these lows were taken. This is instead of a form of sell side liquidity, this is a break of structure because we were switching from being bullish to bearish. So there's two ways on identifying when fair value gaps are going to work and not going to work. When you're in a bullish trend and you see price trade down to take these lows, if your higher time frame is still bullish, then this is a valid form of liquidity taken, and you can possibly find a fair value gap below that and then trade back up higher. But because we were reversing here, price is using this as a break of structure and will use these fair value gaps to then drive price down lower. As you can see, price drives up into there, here, and then moves back down lower. But if we had a bullish higher time frame, price would have driven down here, taking out these lows, and then continue back up higher. Now, fair value gaps are a little bit tricky, and I'm going to get in depth now. So for my intermediate and advanced traders, now is the time to pay attention. And for my beginner traders, now is the time to take a lot of notes and don't skip the videos. This is where it really does start to get tricky. And how do you identify that fair value gaps are going to work? Well, there's something called consequent encroachment of a fair value gap. So if you draw your box out here, there's a setting that's called a middle line. This draws out the 50% from the high to the low of the fair value gap. When price bodies or wick, depending on the scenario, respects this 50%, that's an indication of price going to respect your fair value gap. In this indication, it's an indication that we were going to continue down lower. So as you can see, it trades into it. The wick goes up above it, but the body stays below it or just at it. And then we continue down lower. If we drop down to a lower time frame and we look at an example of a very high probability entry, you can see right here. And again, I didn't pre-find this. I'm just opening up the chart and I'm just looking at it. And I was like, oh, this is high probability. Let me take it. So you can see price trades back down into it. And then not even the body, but the wick, and then trades up above it. What makes this super high probability is the fact that it wicks to it and the wick doesn't even touch consequent encroachment. Remember that 50% midline of this gap. This is what makes it high probability. This is also what kind of indicates price isn't going to go down to lower fair value gaps because it's already respecting this. Now, what do we do here? Look at that, a little bit of a wick. The highest probability fair value gaps respect the upper part of the fair value gap and don't trade down here. This is kind of like the no-go zone. If you are very bullish or bearish, you want to anticipate price to just touch it a little bit and then go back up. Now, in this indication, you can see where price traded all the way down below it and then back up higher. Why? This is an FOMC gap. Big gaps like this is more like a liquidity void where price needs to continue all the way down, fill it out before it goes up. It doesn't have to all the time, but you can see it respected it here. This triggered out buyers, and then it went down lower, took their stop loss, and then it went up. So the market is kind of out there to get you. It will play tricks on you, especially with fair value gaps. That's why you need to take it on the right narrative at the right time. You need to make sure you're doing it at the right time of the day, or else you're going to see a lot of fake fair value gaps. Or in the 1 minute, you can find a lot of fake fair value gaps. Look at all these bearish fair value gaps that failed. Why is that? Narrative. Fair value gaps are one of the highest probability, but wait, there's more. You can trade inverted fair value gaps. What is that? Inverted fair value gaps are where price disrespects a fair value gap and then uses that disrespected fair value gap to trade back down lower. So in this indication, we didn't really have a reaction, but you see this bullish fair value gap here didn't get respected, got bodied right through. This would be a high probability inverted fair value gap because it also broke structure. If you kind of know what smart money concepts is, you can see that this is a market structure shift, a high, a low, a higher high, a lower low. This took a high, traded back down lower. If it would have traded in here, valid entry, go down to target these lows. This is a inverted fair value gap. Now, here's where I'm going to go deep. Inversion fair value gaps are best used after the candle that gets disrespected took a form of liquidity. What do I mean by that? Don't just take every inverted fair value gap. Wait for a fair value gap that breaks a form of liquidity and then gets inverted. That's a valid inversion fair value gaps. A lot of people tend to use fair value gaps that just get inverted and they call it an inversion. It's not. You need to wait for price to either rebalance and take internal range liquidity or take external range liquidity like this high. And it also broke structure. So this is a valid inversion fair value gap. We did not trade to it, but we did trade lower and take sell side. Now, we're going to move over and look at just a random session here and try to find an example of where price respects consequent encroachment and indicates that it's not going to go to higher fair value gaps. So you can see here, we draw out this box. Look at the bodies. What happens? The bodies stay below that middle line. So whenever you're in a situation where you see three fair value gaps like this, and you're like, which one will it go to? Where do I put my stop loss? Well, you wait. You wait for the candle to close. Once the candle closes, you can see that it's respecting this one. Now let's jump a little bit in more depth and really focus. This is where you're like, there's totally an algorithm out there. Trades away from this one. Look at this wick to the tick of that line. Just touches that line and trades lower. So you have two opportunities to get in short from this little fair value gap. Sizes of fair value gaps don't really matter when they're not that big, but when fair value gaps are massive, it does change the fact. When they're small, you have to really pay close attention how it's being respected. But you can also see the original move that we went down off of. What happened? Price respect consequent encroachment. So yes, sometimes fair value gaps don't respect consequent encroachment and still respect the. Sometimes price don't respect consequent encroachment and still respect the fair value gap. But majority of the times, if the fair value gap is going to work, that middle line will be respected by the bodies at least. So it's better to just only trade fair value gaps that respect consequent encroachment to up your win rate. Yes, you might find less entries, but that is the best thing to do. Now, one more thing about fair value gaps. It's really, really, really important to look at fair value gaps that take a low or a high. Those are the higher probability fair value gaps. You can see, what do we have here? Relative equal lows. What does this candle do right? Sorry, give me a second. What does this candle do right here? It takes these relative equal lows, displaces it, and holds it, does not overlap it. So then when we rebalance that buy-side inefficiency gap, when we rebalance that buy-side inefficiency gap, we trade back up into it, respecting consequent encroachment, clear indication of we're going to move lower. Now, the next available entry is right here. What happens when price retouches that fair value gap? If you want to wait for a draw on liquidity, you totally can. You get an entry here, right? Price went down lower, respecting mean threshold or consequent encroachment, broke this low, traded back up, respected it with the wick, and it did not break this high. Continued down lower. Then what happened? This displaced below this low, again, forming a fair value gap, trading up. Look at that. Touches consequent encroachment, trades back lower. This is not random, folks. This happens every single day where price will respect consequent encroachment of a fair value gap. And it's really, really, really important to pay close attention to the levels inside of the fair value gap. Now, if you want to get a little bit more algorithmic here, you can get your, not standard deviation, sorry, you can get your Fibonacci here and measure out the quadrants of the fair value gap. This is where price really tends to change. If you really want high probability fair value gaps, the lower quadrants should be respected by the bodies. Look at this. Look how many times it trades up into 50%, but the bodies stay below this lower quadrant. Let's use this little gap as an example. It's hard to see, but the bodies are respecting that lower quadrant. Now let's use this one. Look at that. Look at that. Respects the lower quadrant. All high probability, all indication of high probability. Levels are crucial to use in fair value gaps. I recommend using the quadrants. You don't need to. You can just use consequent encroachment, but if you want higher probability, you can pay attention to the bodies. The wicks also tell stories. If the wicks respect it, it means it's even more bearish. So pay attention to consequent encroachment. When you're looking to see which is the right fair value gap to find, you pay attention to consequent encroachment of the fair value gap. This is one of the most crucial PD arrays to pay attention to and to learn. I hope you guys found this video insightful, and I hope you know about fair value gaps. If you don't, there's a lot of videos out there, and also my Discord teaches a lot about them. Again, quick, brief recap of what a fair value gap. It's a 3 candlestick pattern. You can see here's an example of a bearish fair value gap, 1, 2, 3, where the first and the third don't overlap each other, including the wicks. So let me put my magnet tool back on here. Here's a fair value gap. One last point, if you have a fair value gap with a volume imbalance, like this, how do you measure the fair value gap? Like this? Do you measure the fair value gap like this and leave that gap? No, you measure it to the body, covering the whole gap. There is your fair value gap. Look at what price does here. Respects consequent encroachment. The bodies even respect the upper quadrant, and it trades back up higher. Guys, it's algorithmic. It's programmed. It's programmed to work. You just need to know what to look for. And couple this with macro timeframes, which I'll get in depth to soon. And boy, you have a profitable model. The fair value gaps that get filled at specific timeframes are the best fair value gaps. And I'll get more in depth on that when you get more advanced into this boot camp. But there's the silver bullet model, first presented fair value gap at 10 a.m., first presented fair value gap at 9:30, first presented fair value gap during the macros, so on and so forth. Study fair value gaps, wait for the macro bootcamp video to come out. That's where you're going to learn so much. So thank you guys for watching this video on fair value gaps, and I'll see you guys on episode 4 of Benjamin's Bootcamp. Take it easy.